the reason you guys are listening is, why is this stuff important, right? I mean, VIX is good for us option geeks and stuff, but why is it important? So first of all, it's probably one of the most important factors in the pricing of options. So if you sell low IV options, then you're not going to be compensated as well for the risk that you take for that trade. So that's one thing. It's super important to know what the IV is when you're looking at a trade. So say, for example, you're looking at two separate put spreads, and we're saying, which one do we want to do? They're both equally as good based on the chart. If the IV is higher on one versus the other, we might get as much as 30% higher credit just based on the IV alone. So, so that's a good reason, right? We want to know. So here's kind of a quick calculation of how do you calculate the expected move. So the SPY at the time was at 416. I wish it was at 416 again. And the IV was 34.9. So to calculate the average move, the expected move on an annual basis, you would just take the 416 times 0.349. And that means that over the course of a year, that the S&P or the SPY would be expected to move up or down 145 points. So that means that somewhere the cone of expectancy would be between 271 and 562. So that's a big range, right? So, and it's a lot driven by a higher implied volatility. So if you're trying to calculate a period less than 1 year, all you do is you take that annual move, the 145 days, and you take the square root of the number of days divided by 365. So if you want to do 7 days, you just divide 7 divided by 365, calculate the square root of that, and then multiply it by the annual expected move. Any questions on that? So I thought that was pretty interesting, a way. I mean, most option chains tell you what the expected move is, but this is what it's based on. Okay,